More evidence of KW booming. Actually, that's really impressive what I'm going to show you today. What happens when interest rates go up? So yesterday, Bank of Canada did not increase rates. However, they did say that increased rates are coming. So the Bank of Canada likes to signal to markets what it's going to do, what it's thinking. The reason it does that is so when it moves, that the markets don't go, oh my gosh, and price in a surprise. What we want to do is message, 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 so when it happens, no one's surprised. We often say, you know, the market has baked in an interest rate rise. That's because the governor of the Bank of Canada, Stephen Poloz, messages it. So yesterday was an announcement. They didn't raise, but they said raises are coming. So what happens when interest rates go up? Good stuff happens and bad stuff happens. Pension plans. Pension plans are fantastic because they have a long-term perspective. So what we can do
and Matt Andre, room 209, Chet Schaefer and Matt Andre, 209.
Is we can watch pension plans and see how they invest because their time horizon is decades. So just to give you an idea, the average teacher, so one of the largest pension plans on the planet is the Ontario Teacher Pension Plan. It manages investments.
Social justice meeting is now starting in 211. Social justice 211.
For existing retirees who are enjoying their retirement, but also teachers who are going to be retired. So just to give you an idea, the average teacher teaches for retires at 58 and lives 32 years in retirement. Retires at 58, lives 32 years in retirement. That means the average teacher lives to 90. So a teacher who starts teaching fall of 2018, the pension plan has to plan for that teacher to live to 90. So we're talking like 7 decades down the road. So that's great because that's long-term investing. Of course, you as young investors have a long-term perspective. So what do they do? How are they doing? And what kind of gains are they getting? I'm going to spend a good chunk of today technical analysis. Some of you have asked me, geez, I'd like to see more about that stuff. So I'm going to talk a lot about technical stuff today. And then TD Virtual Stock Market Simulation. So the majority of you were in classes such as Vicky, and we're playing the stock market, and Aiden, we're playing the stock market simulation during the winter, but the game is now ended, and Aaron. So I'm going to encourage you to get going. Get going on the TD Stock Market Simulation and get going. I love the TD Virtual Stock Market Simulation because it's American-based, which means you've got to focus on American companies. And we know we have a Canadian bias, and because of that, we underperform. So that's the agenda. Let's have a look. Wait till you see this. This was in the paper yesterday. I'm always thinking of you. Look at this. This is happening. 33-story Kitchener condo tower to be tallest building in the city. So if you don't think the LRT is shifting the landscape in KW, you're crazy. If you don't think UAW and Laurier and Conestoga creating jobs, Google coming here, all of those things are fantastic. This will be the tallest building in Kitchener-Waterloo, 33 towers. Units are going to start at $250,000 and obviously geared to young professionals who don't even have a car. Living downtown and on the LRT. Maybe I work at Sun Life, maybe I work at Google. I walk out of my condo, I hop on the LRT, away I go. Harvey, don't forget to sign in, please. Okay, so anyway, KW is booming. Real estate's going to pop. Continue to pop. Good news. I think there's going to be lots of jobs here for a long time. What happens when interest rates go up? So you know I'm a big fan of getting a HELOC, right? A home equity line of credit. So it sure beats, you know, paying 5% on a home equity line of credit compared to paying 28% carrying a balance on a store credit card or 19% carrying a balance on a Visa or a MasterCard. But what happens when interest rates go up? Well, Canadians love HELOCs. HELOC stands for home equity line of credit. You can get a line of credit that's unsecured also. So you can go get a line of credit just based on your income. I've shown you that with me before. All of my lines of credit are unsecured. I don't have anything that's secured. And the reason is because I don't want them to take collateral. My house is collateral. That's what they do. Because I'll pay more in home insurance. So that's something for way down the road. When you do pay off your mortgage, way down the road, you call the insurance company because you don't have any outstanding liens on your property. Your insurance rates go down. Anyway, I got enough access to cheap money. But my point is this, Canadians have embraced these home equity lines of credits. As their homes have gone up in value, they've been able to get access to more money. And boy, we're addicted to it. As you know, Canadians are the most debt-laden set of consumers on the entire planet. How bad? Bad. Look at the numbers. 2 separate interest rate threats facing the people who have collectively borrowed. Look at that number. Not very often I say trillion in class. That is $1/5 of $1 trillion. Canadian consumers, not businesses, Canadian consumers, your parents have racked up $1/5 trillion in HELOC debt. Wow. Using home equity lines of credit. So obviously the first risk is that all of those folks, once interest rates tick up, the interest rate on your HELOC goes up. Yeah, you'll pay more in interest. So how much of a balance do these folks carry? Look at this. Staggering. Smartest way to borrow. So balance, yeah, there's a 200 billion again. I wanted to get the average account balance, and I saw it on here. I'll cover this paragraph first. Again, HELOCs are a great thing. Smartest way to borrow for expenses you need a little time to pay off. Low interest rates have drawn lots of people into depending on them to sustain their lifestyle or buy extras they can't otherwise afford. There's growing concern about how people will manage all that debt. All right, here's the stat that caught my eye. Earlier this week, the insolvency and consulting firm MNP released a quarterly survey. Look at the percent. 43% said we're in deep trouble and feeling the effect of interest rate rises. Up 5% from 3 months ago. Almost half of the survey said they didn't think they'd be able to cover all their expenses in the next 12 months. What? That's unbelievable. I'll read that to you again. Almost half said they didn't think they'd be able to cover their expenses in the next 12 months without going into more debt. So these people are addicted to debt already, and they don't think they can keep going unless they take on even more debt. Now, dollar amounts. How much are they actually carrying? It's going to scare you. It's big. TD said interest rate increase of 0.5% of a point on a HELOC would increase interest costs by 42 cents on 1,000, which doesn't sound much. Federal Consumer Agency of Canada reported last year the average HELOC in the country is $70,000 bucks. Grab a calculator. Let's figure out what a couple of quarter-point interest rates do with a $70,000 line of credit. So we want to take $70,000. We're going to type in half of 1%. So the way to do that is you type in 0.005, decimal 0.005. That would be the increase, about $350. We're going to divide that by 12. That's 30 bucks a month. If their HELOC interest rate bill goes up by 30 bucks a month, they're in trouble. That should make you think for a moment. What happens if their car needs a new engine, or needs a new transmission, and they get a 2,000, or the roof starts leaking? Like, they can't even absorb 30 bucks a month. That's how stretched they are. Staggering to us, right? So again, HELOCs are great, but people are addicted to them. They're putting all kinds of stuff on it that they shouldn't. So when interest rates go up, people stop sleeping. They get terrified. They were gorging as interest rates went down, and now they're in deep, deep trouble because they're exposed. Next, pension plans. This is my pension plan. Check this out. This is, again, one of the largest pension plans on the planet. So the pension plan, the Ontario Teacher Pension Plan in 1990 started to invest in equities. Before that, they just bought safe stuff like bonds. Super safe, like Government of Canada bonds. No risk at all. Because of the government, if the only way that's not paid is if the government goes bankrupt, which isn't going to happen. Obviously, they just print more money. How cool is that? All right, watch this. Since 1990, the plan has been funded by 10% member contributions, 11% government contributions, and the rest of the gains, 80%. So that entire plan, all of the money in the plan, 10% from members, 10% from government, the other 80% from gains. So fantastic long-term investing. How big? Big. There's the pension plan, $190 billion. The Ontario, somebody runs $190 billion. I'd like to go into work on a given day and you run $190 billion. So Jacob Robinson, one of our past presidents from several years ago, Laurie Honors Biz, got a summer co-op job at the Ontario Teacher Pension Plan. How cool would that be, to be inside running $200 billion? Again, $1/5 trillion. Now, look what they did. They beat the benchmark by 1.5%. So that we know how hard it is to beat the benchmark. How did they do last year? Up 9.7. They grew $1/5 trillion by 9.7% and beat the benchmark. That is the value of having a long-term perspective, not worrying about playing pot stocks, not worrying about the hot stuff. Long-term, buy and hold for decades. Just holding for the long run. Look how lucrative it's been. Again, because of your age, that's exactly what you want to do. Buy a bunch of, you name it, quality dividend growth companies, hold them in a portfolio, and do nothing. Just hold on to some Canadian banks, hold on to some tech companies, and do nothing. Long, long, long term. And again, if the market peels back, go buy some more. Amazing, eh? That's what it looks like. All right. Time to get a little bit technical. Here we go. So this is going to be fun. I know you're going to enjoy this. So I'm going to spend some time now looking at what's going on in the markets and talking about how you can create a portfolio. So we've talked earlier about those fantastic new Vanguard products, right? The global ETF, right? Core and Explorer idea. So let's say that you get going and you're like, okay, I want 3/4 just vanilla global ETF, core holding, buy and do nothing with. And then I'm going to explore. So for the other quarter of my portfolio, because I enjoy watching the markets and I enjoy investing and I enjoy watching themes, I'm going to explore. And what that means is I might buy 2 or 3 or 4 different products. They could be individual companies or ETFs. I would encourage you to consider ETFs because of the fact that you manage risk. So we all get the fact that investing involves risk. Can we mitigate risk? Yeah, we can mitigate risk. We mitigate risk by investing globally. We mitigate risk by investing for the long term. We mitigate risk by avoiding a company-specific bet. We mitigate risk by, we understand that. We can manage risk. The stock market over time goes up. So the Core and Explore strategy says global ETF, no bets, buy the whole planet, keep costs super low. But maybe I want to pop my returns a little bit. If you think about it, the Ontario Teacher Pension Plan popped their returns. They didn't just get the benchmark, they beat it by 1.5 points. You try to beat it running $200 billion. Imagine every point on that, how significant that is. All right, so let's have a look at how we can start to look at this Core and Explore idea. So what I did was I Googled S&P 500 sectors, and these are called spiders. And so if I look at the 1 year, here's what this chart tells me. Okay, so here's what I'm trying to do. I'm trying to pick the sectors that are going to outperform when I want to have a look at buying something. I was looking at this last night, I actually did it with some of my own money. So the S&P, we'll go out 5 years. The S&P 500 over the last 5 years up 75%. Hooray. We know the Canadian market over the last 10 years is flat. Like the Canadian market over the last decade is up like 11%. So again, ridiculous to have all your money in Canada. So there's the S&P 500 up 75%. Okay, are there any sectors that have beat it? In other words, the entire index is up 75. Who's beat it? Well, let's have a look. Tech has beat it. Wouldn't be a surprise to you. What else has beat it? Yep, industrial's beat it. What else has beat it? Consumer discretionary. What is lost? Consumer staples is under, real estate's under, utilities is under, and energy's under. So if you bet on those losing sectors or sectors that weren't up as much, you underperform the index, right? That was expensive for you. So let's say, for example, we want to look at the hot sectors right now. Mr. Murray just, what's hot right now? So that's out 5 years. Here's the 1 year. So again, same cold industries. Consumer staples, real estate, utilities. These guys suffer when interest rates go up because utilities pay a nice big fat dividend, and so does real estate. Real estate, and think of real estate income trust, they pay a dividend. So when interest rates are rising, this stuff will fall. So a little bit of economics. If interest rates are rising, that means the economy is going well. If the economy is going well, it's booming. Companies will spend more on tech, and consumers will spend more on consumer discretionary. Consumer discretionary, consumer staples are not the same thing. Consumer staples is, I need to go buy groceries. Consumer discretionary is, I want to buy a new car. Do you understand the difference? So what's going on? Interest rates are rising. Why are interest rates rising? Because the economy is booming. Bank of Canada starting to see inflation. People are spending. Times are good. So people will spend more stuff on, more money on discretionary purchases. Okay, how much more? And what's in here? Watch this. So I can get a, look at this sector heat map. I love this last night. I was all over this. All right, what's the sector heat map? Okay, there are the 10 sectors of the S&P 500, and we see how hot they are, and I'm going to go out again 5 years. So again, there's tech wickedly hot, up 130%, and here's the cold stuff down here. All right, let's look at tech a little more. Now, this is cool. I can buy XLK. It's the tech ETF. So basically, it's like buying the NASDAQ. What do I get? I get a lot of Apple. So the bigger blocks indicate size of piece of the index. Okay, we know these tickers, right? You know this. Microsoft, Facebook, Intel, Google. There's a whole bunch of small companies. How much Apple do I get? 15% weighting. So if you buy this ETF, you'll get a 15% weighting in Apple. Good spot to be. Let's have a peek at another one. Okay, the other one I noted that was a little bit warm on the 1 year was consumer discretionary. What's in here? Again, we'll heat map it. XLY, Amazon, Netflix, McDonald's, Nike, Home Depot. Would it make sense that Home Depot gets busy if the economy picks up? Sure. People will do a reno, they'll expand their house, they'll take on a project that they might not do if the economy's not in good shape. So what we can start to do is say, okay, I want to buy a couple of these ETFs. I want to put a couple of these ETFs in my Explore section. There's my core, buy everything global ETF.
Kelvin Kellner to room 224. Kelvin Kellner 224.
So the two ones that I'm looking at are the tech one. Okay, the tech's ticker is XLK, and I'm just going to go 1 year again, see the other hot one. There it is, XLK and XLY, so Y and K. So what do we want to do? We want to buy some of that on the TD Virtual Stock Market Simulation. How do we do it? I opened this last night. It's easy. It'll take you 1 minute. You just have to say you're older than your actual age, because I think you can't be a minor or whatever. It's just make up an age. It doesn't matter. So I created this. All you have to do is an email account. And I put in some shares yesterday for Google. I put in one just to make sure the account would work, and it is. There's my one share of Google. Look at that. I'm up $7 already this morning. Yay me. So again, what do I do? Well, let's go back. We have to check price. So I'm going to buy some XLY. There's what it holds again. So Netflix, Amazon, Best Buy, Dollar General, etc., etc. I want to see what it's trading at right now. So I want to go back to see a little chart here. Oh, this is another. I was playing with this last night too. Okay, I'll do this with you. Watch this. Over the 5 year, there's tech and consumer discretionary, right? So tech obviously has been in good shape. Tech currently trading at $105 a pop. And my XLY currently trading at, same thing. Okay, so 105, I'm going to buy some of this. How do I do it? Just like the Nipissing game, make a trade, trade stocks. What do I want to do? I want to buy XLY, I think it was. Let's see if I got that right. There it is, consumer discretionary. Okay, it's trading at 104. I want to buy 10,000 of it, let's say. So we want to grab our calculators. We're going to start. Well, this game's a little bit different. It's $100,000 as opposed to the game you had, which was $500,000. You can still only spend a quarter of that. Let's spend a quarter. 25,000 at $100 a pop. I can buy somewhere in the neighborhood of 250. This is in American dollars, so you don't have to worry about the currency exchange. I'll just put in 240, so I'll make sure it'll go through. Preview it. Estimated cost, $25,000. Wow, I got under by $28. Good for me. There it is. Done. All right, so what did we learn? The Ontario Teacher Pension Plan knows what they're doing. They beat the index. They've accumulated massive money. They have a long-term perspective. The way for us to avoid a big mistake, a global ETF like that Vanguard family, and hold them. And then if we want to explore a little bit, I would suggest that you avoid making bets on particular companies. You have company-specific risk. You have country-specific risk. If you pick Alibaba, you have country-specific risk on China, and you have company risk. If you pick a global tech, you get it. All right, so we know that we can move in this, we can create this. I would encourage you to get yourself going on the TD virtual stock market simulation. Mr. Murray counted, we only have a few weeks left. How quickly this will go now. I only have a couple of weeks with you before it's all wrapped up. So get going, create your account, start tracking. We'll talk more about this in 2 weeks' time. I'll see you in 2 weeks. Thanks, everyone.